All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today's March 6th, 2025. And there is once again a great disturbance in the force this morning. A global bond sell-off is underway, and it's being led by Europe, but also we've got Japan participating. Pay attention, guys. I don't know what exactly is going to come out of this, but I do know there are an awful lot of very big banks in Europe and Asia who loaded up on government debt when interest rates were negative. And now interest rates are going vertical thanks to the debacle that happened in the Oval Office last week between President Zelensky and President Trump and Vice President Vance. And, remember, guys, the inverse correlation between bond yields and bond prices, if we're watching interest rates go straight up, that means we're watching bond values go straight down. And if you're a bank and you own a whole bunch of those bonds, well, scientifically speaking, you're hosed. So who's it going to be? Is it going to be Norinchukin? Is it going to be Deutsche Bank? I don't know. Somebody's going to blow up if this keeps up. European bond yields are currently at levels we have not seen since the gilt crisis of 2022. I don't know if you guys remember when Liz Truss was the prime minister very briefly in the UK, and she announced that there was going to be a big tax cut while they were already in the midst of a debt crisis. The bond market panicked. The UK pension system almost collapsed on that news. The European Central Bank started printing pounds right in the middle of the night, and it led to Liz Truss resigning as prime minister. It was a fiasco, and Europe is steamrolling right back into the crosshairs of that. But again, it's not just Europe. I mean, yeah, we're seeing bonds in Germany, in Italy, in the UK, in Spain. They're all spiking. But we're also seeing it in Japan. The 10-year Japanese bond, the yield on that just hit the highest level since 2008. Hey, who remembers 2008 and what a great time that was? Okay, so Japan is spiking. Anybody remember that whole yen carry trade thing? Remember August 5th? Remember the stock market panic when all the brokerages, oh, sorry, guys, we're having a problem with our systems. Nobody's allowed to sell stocks in the middle of the morning when everything was crashing. Yeah, we're seeing the 10-year yield is even higher than it was during that event. And again, much like European banks that loaded up on negative interest rate debt in the early 2020s, you've got banks in Japan that loaded up on that negative yielding debt. And Norinchukin, one of the third or fourth largest bank in Japan, they've already been having problems. And that was when interest rates were a lot lower than they are now, which means those problems have not gotten better. They've only gotten worse. Now, what's going on here is the European countries led by Germany are going on a spending bender. They're using the pretext of the Ukraine war and this blow up that happened between Trump and Vance. But guys, that's not really what's going on here. There is some subtle wording. If you look at what they're actually calling these funds that they're about to pop up here, it's not just defense. This is a general spending bender that they're getting ready to go on here. We're going to look at the wording of that. Also, the European Central Bank cut rates today. Guys, they're going to inflate. That's what's coming. I mean, it's pretty obvious. Europe is going to inflate here. They cut rates today. They're saying it's going to be the last rate cut for a while, or at least they're kind of hinting. They're going to wait until something blows up, and then they are going to Zerpenberg. All right. Also going on this morning, we've got challenger job cuts, the biggest spike since the pandemic in challenger job cuts, thanks in no small part to the DOGE, the Department of Government Efficiency. All these federal job cuts are showing up now. And take away the pandemic, it's actually the highest challenger job cuts since 2008. There's that year again, since the GFC. You got to love it here. Initial and continuing claims also came out this morning. We're going to look at that, and we've got that all-important non-farm payrolls coming out tomorrow, guys. That's going to be a big one. Get ready for a lot of recession talk. Get ready for a lot of stagflation talk. They're both coming. And a story near and dear to my heart. Oh, my God, say it ain't so. There's a story this morning in the Financial Times. Microsoft is walking away from contracts with Coreweave. Oh, who had that on their 2020s bingo? The biggest IPO of the year. It's about to hit. And, well, their biggest customer, 62% of their revenue is canceling contracts. Not all the contracts. We don't know how much. They didn't include a lot of numbers in this article, but they're citing delivery issues and missed deadlines as reasons for canceling these contracts. $10 says they try to pass this off as a supply constraint problem because demand is insane. Mark my words, that will be the statement that the company releases. So that IPO is off to a horrible start. We've got Klarna is planning on IPOing very soon. That's a buy now, pay later firm. Alibaba, along with another half dozen Chinese companies, are out with brand new AI tools this morning. That space is getting awfully crowded. And Marvell, the chip maker, who's seen a lot of gains since this AI bubble started inflating, their stock is crashing this morning, even though they just reported pretty good earnings. Why? The guidance came in a little light. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in markets, shall we? And guys, while we're doing that, don't forget that like button for the YouTube algorithm and that subscribe button so you can come back tomorrow because we do this every day. So come have your coffee with the melon heads as we go through markets. And it looks like a bad morning for the S&P. We're currently off by 65 points, 1.1% lower for the S&P 500. The Dow is not far behind, down 355 points, 0.82% lower for the Dow. And the NASDAQ is leading the way lower here, off by 300 points ahead of the open, minus 1.46% for the tech-heavy NASDAQ this morning. And we have got a lower dollar once again, 104.03 on the DXY. We even had a 103 handle for a while there this morning. 29 basis points lower. What is going on? The yen is surging and the euro is surging, and that is driving the relative value of the dollar down versus those currencies, and they are both big inputs into the Dixie math. Now, looking over at the bond market, we've got a little bit of a steepening or a uninversion of the yield curve going on this morning, depending on what phrasing you want to use. The 30-year Treasury is a little bit higher by 2 basis points, 4.580. The 10-year is at 4.294. That's up almost 3 points. The 2-year, meanwhile, is down 2 points, 3.965. And the 1 month is down almost 1 point at 4.312. Looking over at the commodities board, we've got gold is off by about $9.45 this morning, $2,909 for gold. That's lower by about 1/3%. We've got spot silver is at 32.42. That's down by about 23 cents or 0.75% lower here this morning, but I still like the shiny. Copper is unchanged. Platinum is up by about 0.75%. Palladium is up by almost 1%. And crude oil here actually catching a little bit of a bid this morning, $66.69 for April WTI futures. That's higher by about 38 cents. Or 0.56% higher, but oil has had a rough couple of days. I do think oil is heading lower for the time being. Looking over at Bitcoin, we had a nice rebound in Bitcoin over the last 2 days, and it looks like we're heading a little bit negative here. We were briefly around 91,000 this morning, but currently 89,672 and heading lower. That's off by about $940 on Coinbase this morning. I'm guessing that sell-off in the NASDAQ probably going to drive Bitcoin down with it. Now, let's look at what's going on overseas here in Europe, guys. Worst German bond rout since 1990 sparks global debt sell-off. That's some particularly doomy language for Bloomberg this morning. Worst rout since global debt sell-off. But, guys, that's what's happening here. I mean, this is not an exaggeration. We are seeing a big shift in the tides of the global debt market. And make no mistake, guys, world leaders, if they have to, they will sacrifice stock markets to save bond markets, because without bond markets, our worthless leadership cannot continue with their worthless leading. And so they will save the bond market at any cost. German bonds extended their rout, with debt markets around the world sliding in the wake of Berlin's historic plan to unlock hundreds of billions of euros for debt and infrastructure. Pay attention, guys. They're saying the quiet part out loud here. All right. Look at what they're saying here. This whole thing started because of, oh my God, the Orange Man said mean things to President Zelensky. Now Europe needs to defend themselves. Good. Defend yourself, Europe. I'm sick of footing the bill for your freaking military. But besides that, notice the word infrastructure here. Hundreds of billions of dollars Berlin's historic plan to unlock hundreds of billions of dollars for euros for defense and infrastructure. Where did that and infrastructure come from? Can anybody tell me? I thought this was about Ukraine. I thought this was the United States is not going to come to our aid. We're worried. Orange man bad. Europe's going to have to build its own military. All of a sudden, infrastructure? And we saw during prior administrations how the word infrastructure, you can play with that definition to include anything. Oh, Greta wants more solar panels and windmills. That's infrastructure. Oh, you want money to fund some social initiative or unicorns and rainbows? And sure, that's infrastructure. Why not? This is a spending bender Europe is getting ready to go on. They just wrote themselves a blank check for €500 billion. 500 billion euros Germany has just unlocked, and they're calling it an exemption to the spending break. That's what they're saying. Well, the spending break, that's their version of a debt ceiling. And well, now we've created special things that are outside of the debt ceiling, and we can do whatever the hell we want there. And since we're using vague phrases like defense and infrastructure, well, anything and everything will quickly fall under that category. Get ready, guys. Europe is going crazy on the stimulus. They are governing crisis to crisis, giving themselves more power and more authority every single time. Yields on the 10-year boons continued their march, adding as much as 14 basis points on Thursday to reach 2.93%, the highest since October of 2023. The rate jumped 30 basis points on Wednesday, the biggest increase since the months after the Berlin Wall fell in November of 1989. Yikes, we're going back now. Now traders are looking to a meeting at the European Central Bank for signs that officials could ease the pace of rate cuts. Christine Lagarde was talking when I went live, so we'll see if she gives any clues about the direction they're heading there. The sell-off in German bonds reverberated through global debt markets, with Japan's government yields reaching their highest levels in more than a decade, and yields in Australia and New Zealand also surging. Italian yields jumped above 4% for the first time since July, and UK gilts extended losses for a second day. This isn't just one country, guys. This is all over the world, Japan, Europe. And, let's take a look at this. This is the German this is wrong thing here. Let's look at the Deutsche Bond, all right, the German 10-year Bund. All right, look at what this thing has done in the last couple of days. Now, it's off its highs this morning, currently 2.861%. It was as high this morning as 2.929. It's come down a little bit, but this is a big jump in just a couple of days. Again, it was triggered by that Zelensky Trump spat and Vance spat, but now because of that word infrastructure that they're adding, they're just going to use this as an excuse to spend money on all of the slop that they spend money on. Everything is now fair game. It is going to be a free-for-all in Berlin, and we are the highest that we have been since October of 2023, and before that, well, you got to go way back before that. We're also watching the euro surge. This is USD, EUR, the number of euros it takes to make a dollar. It is heading sharply lower. Again, that is the euro strengthening versus the dollar. Pay attention, guys. Strong euros, high interest rates, not good for European banks that loaded up on that sovereign debt during negative rates. Watch those unrealized losses. And when that becomes a problem, and it will become a problem, somebody will blow up any day now in Europe. Watch how fast they spin up the money printers to solve that problem. Mark my words. That is, unless, of course, it happens in Japan first. Look at the 10-year Japanese government yield, 1.52%. It was as high this morning as 1.554. A big jump overnight in Japan. And, guys, let's zoom out on this chart. Look at what the 10-year borrowing cost in Japan has done. It's done nothing but go up, really, since 2020. And to really get a comparison, we got to set this to 1 month candles, and we are going all the way back. When's the last time we were here? June of 2009. Before that, October of 2008. Can somebody remind me, was there like a thing that happened back then that wasn't so good? My memory's a little foggy. But look at this surge in borrowing costs for Japanese government debt. Watch that unwind of the yen carry trade. People have borrowed yen at low interest, sold them for dollars, and then bought U.S. assets with those dollars. That is known as the yen carry trade. And if the yen keeps going higher, oh, by the way, look, the yen, going higher. This chart heading lower, that's the yen getting higher. As the yen goes higher and as interest rates in Japan go higher, that trade becomes less and less profitable, which means you start selling those U.S. assets like tech stocks, NASDAQ down 300 points, converting those dollars back into the yen and then paying back that debt. That is the unwind of the yen carry trade. And that is what caused that panic selling in August. And we could very easily see that resume. So who's going to blow up first, Europe or Japan? Will it be Deutsche Bank? Will it be Nochu? Let me know in the comments. Place your bets, folks. My money is on Nochu right now. Mish was saying Deutsche Bank this morning. I'm going to say Nochu just because Nochu was already in problem territory. But hey, Europe cut rates for the 6th time in 9 months this morning. What happened? Let's the update. Here we go. ECB cuts rates for the 6th time in the face of economic upheaval. The European Central Bank has cut interest rates. Let's see, they dropped by 25 basis points with inflation closing in on its 2% target. Yeah, right. The central bank for the Eurozone lowered the rate it pays on bank deposits by 25 basis points to 2.5%, a level it saw as meaningfully less restrictive. Look, the European governments just wrote themselves a blank check. Monetary policy in Europe will not be restrictive for much longer. Mark my words, folks. And meanwhile, midnight, easy, buddy. My cat is shredding my feet right now as we talk, but that's all right. It's real easy to keep your concentration when your cat is attacking your feet. U.S. employers announced 172,000 job cuts in February. In February of 2025, that is the highest value since July of 2020, compared with 49,795 cuts in January. Look, guys, big spike in job cuts. We saw this one yesterday. Shout out to my friends over at Macro Edge who made a similar call. They were actually within just a few thousand of the challenger number. A lot of job cuts were announced in February. Most notably, it looks like the DOGE is finally showing up in the labor data. With the impact of the Department of Government Efficiency actions as well as canceled government contracts, fear of trade wars and bankruptcy, job cuts soared in February. Andrew Challenger said that as the firm's workplace expert. Guys, we get non-farm payrolls tomorrow. It's a big data point, and right now it's not looking so good. I don't know that these job cuts will necessarily show up in payrolls, but it sure as heck isn't going to help. I can tell you that. Big spike here. Watch that labor market. If we get a bad jobs print tomorrow, you're going to hear a lot of talk about recessions and a lot of talk about stagflation. Get ready for that. Meanwhile, we got initial jobless claims this morning. Initial claims in the United States decreased to 221,000 for the week ending March 1st from 242,000. So what's going on here, guys? We saw a decrease in initial claims after just talking about that big spike in challenger job cuts. Well, it turns out government jobs are not counted under initial and continuing jobless claims. I didn't know that. There is a whole separate government program for federal employees and unemployment claims. And so initial jobless claims doesn't include that data. I didn't even know that. So that's why initial claims is going down, even though challenger job cuts for the month are going up. I would also add the challenger job cuts. This is the whole month of February. Initial claims is a weekly data point. So those challenger job cuts will include the big spike in jobless claims that we saw last week. Continuing claims, though, the number of people who have been unemployed for 4 weeks or longer, that number rose here. Continuing claims in the U.S. increased to 1,897,000 for the week ending February 22nd. That's up from 1,855,000. So a healthy jump in continuing claims. Those people who lost their jobs 2 weeks ago are having a hard time finding new jobs. And I would add, this is kind of the upper bound here. We've been in this range for a couple of months now. It looks like we may be about to break out in higher levels. Guys, the job market is weakening any way you look at it. Inflation is stubbornly high. Europe is going on a spending bender. There is trouble brewing in banks. Oh, what's the worst thing that could happen? Oh, we also got this AI bubble going on, right? And how about this one? Microsoft withdrew some Coreweave agreements over delivery issue. Financial Times reports. Oh, that IPO. You should have IPO'd 6 months ago, Coreweave. You were too greedy. You could have got away with it if you didn't wait so long, but you had dollar signs in your eyes, and now your problems are being laid bare for all the world to see. Microsoft has moved away from some of its agreements with cloud computing provider Coreweave over delivery issues and missed deadlines. The Financial Times reported on Thursday, citing unnamed sources. Delivery issues and missed deadlines. Yikes. Well, watch, they'll just say, oh, it's a supply constraint. Every problem in AI can be easily explained as a supply constraint. Oh, what's going on? You're laying people off, supply constraint. Oh, your chips are overheating, supply constraint. Oh, people are canceling orders, supply constraint. You're filing for bankruptcy. You're under investigation by the Department of Justice for violation of export controls. Oh, it's just a supply constraint. Microsoft has a number of ongoing contracts with Coreweave that provide it with computing capacity from data centers, a partnership which is worth billions of dollars, the newspaper said. Guys, that is the understatement of the year. Remember, there was a statement in that S1 IPO filing for Coreweave. 62% of Coreweave's revenue last year came from Microsoft, their biggest customer, more than half their revenue, and they're canceling contracts. Now, there was another important sentence here in this article in Reuters. According to the Financial Times, Microsoft's decision to walk away from some business with the cloud technology provider is unrelated to a broader shift in its own data center plans, citing one of the people close to the matter. These people familiar with the matter, they're everywhere. But look, what are we talking about here? Microsoft's decision to walk away from some business with its cloud tech provider, unrelated to a broader shift in its own data center plans. A lot of people spent a lot of energy last week to claim that story from TD Cowen about Microsoft's shift away from their data center plans, that was fake news. A lot of people are saying Microsoft strongly refuted that allegation. No, they didn't. If you actually go read what Microsoft said, they didn't refute anything. They used a lot of very wishy-washy language, and actually, if you read between the lines, confirmed what TD Cowen was saying. So what are they saying here in the Financial Times? If their decision to walk away from Coreweave and some of these contracts is not related to this broader shift in data center plans, are they admitting that broader shift in data center plans is underway? And that Coreweave's decision the decision to walk away from Coreweave is not related to that? Or are they still maintaining this denial that Microsoft is shifting away? I don't know what's really going on here, but it seems like they're acknowledging that TD Cowen note as true, even though a lot of the financial press was trying to say it wasn't true last week. Why? Because the mainstream financial press is largely just sell-side research, and they rarely ask important questions. All I know, guys, is we were told years ago, don't ask questions about this company. Does anybody remember? Don't listen to randos. So, the press told us nothing to see here, move along. And I'm sure that's the answer again. Never mind the shell companies that they ran carbon credits through in the Cayman Islands. Never mind the suspicious involvement of Magnetar Capital, a company that has a history of creating deliberately sabotaged investments and selling them to unsuspecting retail investors while simultaneously betting against that. Never mind any of that. Don't ask questions, just bid up AI stocks. Well, I can't help myself. I ask questions. That's just how I roll. And nobody wants to answer them. I'm just throwing them out there. Also, speaking of IPOs, Klarna to file for $1 billion plus IPO as soon as next week. Pay attention to this one, guys. This would be probably the second biggest IPO of the year. And I think this is another company that missed their window and they waited too long. Klarna is seeking to raise at least $1 billion in a U.S. initial public offering and is set to file publicly as soon as next week. According to people familiar with the matter, the payments business aims to price the IPO in early April, the people said, asking not to be identified as the information isn't public. Klarna is targeting a valuation of more than $15 billion in its New York Stock Exchange listing. Now, here's what's not being said in this article. Klarna, like Affirm, their biggest rival in the buy now, pay later space, they are hopelessly dependent on the securitization of this consumer debt. All right. They don't let this debt sit on their books. They package it up into bonds and they sell it to investors. And in my opinion, that is a inherently flawed business model, and it is not going to end very well to the investors who are buying that debt, because consumers are broke. That's not going to get better with tariffs. That's not going to get better with job cuts. And this debt, I mean, we've seen the statistics. The average person using a buy now, pay later has a subprime credit score. And so you're talking about unsecured debt to people who probably aren't going to pay it back being packaged up into bonds and sold to investors. Stop me if you've heard this one before. So Klarna is trying to IPO before that blows up in their face. Again, in my opinion, this is another company that waited just a little too long. Meanwhile, China's new AI tools ignite stock market frenzy as Alibaba soars. This space is getting crowded. A spate of new AI tools from China sparked frenzied trading in the nation's stock market, propelling an index of tech companies to a multi-year high. Alibaba paced the gains on Thursday after unveiling its latest open-sourced AI model. The platform marked a big leap over the previous version, using just a fraction of the data DeepSeek R1 employs. The flurry of AI announcements included Tencent's new open-source video model Hunyuan and a similar product from short video platform Kuaishou Technology. Earlier this week, Manus AI launched what it called a general AI agent, or a bot that can perform tasks, saying its model is performing better than OpenAI's deep research on some fronts. You guys notice how crowded this space is getting? You notice, first of all, none of these tools work particularly well. They can save you time, but they also hallucinate and tell you entirely wrong things. Lawyers are getting in trouble for making references to court cases that don't exist because they're having AI write their briefs and they're not proofreading them. Look, this space, it's getting crowded as all get out. These stocks are overvalued, and these people are running out of greater fools to sell their stock to. But Alibaba surging yesterday, up 8.6%, up another 1.3%. These are Alibaba's ADRs trading in the U.S. exchanges, up another 1.2% this morning, $142.73. And last but not least, we've got Marvell plunges after forecast trails lofty estimates. This was actually pretty good earnings from Marvell. Big growth in revenue. I mean, they actually beat expectations. It's just that guidance was just a little light. They didn't raise guidance. This goes to show you how these expectations in AI are now so high. If you don't post amazing numbers, they're going to bludgeon you. And that's exactly what happened to Marvell. They declined in pre-market trading after delivering a revenue forecast that fell short of the highest estimates. Not all estimates, actually beat a lot of them, disappointing investors who are looking for a bigger payoff from the AI boom. Sales will be about $1.88 billion in the first quarter, which runs through April, the chipmaker said in a statement Wednesday. Though that was in line with the average analyst estimate, some projections ranged as high as $2 billion. Marvell shares fell 17% in trading before New York Stock Exchange's open on Thursday. They had declined 18% this year and closed at $90.14. And yeah, guys, it's not looking so good for Marvell. $73.85 ahead of the opening bell here, down 18.1%, off by $16. Again, these were pretty good numbers for Marvell. But this industry has risen so much. If you post anything other than outstanding, you're going to get punished. And even in some cases, outstanding isn't enough. Again, they are running out of greater fools to sell to. Not looking so good, guys. Again, the Coreweave IPO marks the top. Mark my words. And I just want to say thank you very much to the Pasta Man. What's going on, Nashville? He says Coreweave has its first goodwill impairment charge. Now we're thinking outside the box here. All right. Yeah, let's get that goodwill. Maybe we'll crank that up. Those are rookie numbers. You know, we got to get that up to about $3 or $4 billion a piece. Look, Coreweave is looking for a $35 billion valuation based on their revenue growth from last year, which was almost exclusively driven by Microsoft. And now Microsoft is canceling contracts. That IPO is not looking good for Coreweave. And by the way, if you look at some of the financials that they filed, remember those lines of credit, the $2.3 billion line of credit, and then the $7.6 or $7.5 billion line of credit that they got a few months after that? They actually reported some of the data on that. The interest rates on those lines of credit, 10% for the 2.3, 14% for the 7 and change. They only actually borrowed like $3.5 billion of that 7. But 14%, I mean, Jesus, I mean, I guess it's not so bad. I mean, they weren't exactly buying GPUs on a credit card, but 14% interest. I mean, the payback for that $3.5 billion at 14% starts in October. Coreweave is looking at something like $660 million of just interest on that debt. Interest alone starting in October of next year. And they had $1.9 billion in revenue total. So, I mean, the debt service cost is astronomical. That says nothing about their hardware cost, about their labor cost, about their power cost, and power's only going up. And now their biggest customer is starting to cut the cord. Oh boy, look out. Thank you very much, Nashville Pasta Man, for supporting the channel. Appreciate the super chat. And thank you to Armando Reyes, who says, do you think anyone is quiet quitting these days? Wonder if we will see 15% unemployment. You know, Armando, I think the quiet quitting was definitely a thing in 21 and 22. I think right now companies are being stressed by the consumer and the general pullback in sentiment that's going on, plus the simultaneous unwinding of work from home, right? Return to office there's been a big push for return to office over the last year or so. I don't think office is ever going to come back to the level that it was. There's always going to be a permanent work from home subset of the population, but it is shrinking for sure right now. And I think the quiet quitters are going to have a really hard time maintaining the status quo if they're called back into the office. And so what I think is going to happen is, the process of getting rid of underperformers. It's going to be step one, you demand that they return to office, and then step two will be the layoffs. So I think, when your boss singles you out as the person who has to come back to the office, that's probably not a good sign for your job security. Will we see 15% unemployment? I'm going to say not this year, certainly, probably not. Probably no. I'll say probably no. If the Fed does nothing, yes. All right, because if the Fed does nothing, sooner or later, you need an ever-expanding money supply in order to sustain a debt-based economy. So if they don't expand the money supply again, then yes, we would get there. But that's a huge if. The Fed is virtually guaranteed to turn the money printer back on. So 15% unemployment. I mean, during the GFC, I think we spiked around 11 or 12. I think was as high as we went. So I wouldn't say it's impossible. I'll say it's highly unlikely in the short term. Let me just put it that way, but not impossible. Thank you very much, Armando, for supporting the channel, sir. And thank you to Cletus, who says, thanks, Jack. Appreciate what you do. You're part of my morning routine. Cletus, thank you so much for the kind words and for the generosity, sir. I appreciate that very much. Thank you for supporting the channel. I am honored and proud to be part of your morning routine. Thank you for having your coffee with the Melon Heads. And thank you to everybody else for having your coffee with the Melon Heads. Oh, Chuck G, you snuck that in right after I hit the music. What? Oh, okay. All right, I got it. What counts as subprime? Sorry, we got to pause the music here. Subprime, correct me if I'm wrong. I believe it's 660 or lower. What is considered subprime? Give me a minute. I believe it's a credit score of 660 or lower. Okay, this is saying credit scores below 580 is deep subprime. All right, 619 to 580 is subprime. All right, so below 620 is subprime. That is the answer. So that's the average borrower of a buy now, pay later loan has credit scores in the subprime range, and that is the average. Half of them are worse than that, and they don't check your credit before they give you a buy now, pay later loan. So it's a good bet. A lot of those deep subprime are also in there. Excellent question, Chuck G. Very sneaky putting that one in after the music. But thank you, Chuck, for supporting the channel. Thank you, everybody, for having your coffee with the Melon Heads this morning. Thank you very much to my magnanimous Melon Heads on Patreon and YouTube. You guys rock. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.